Hey everybody, Signa here with the OEC. I want to do a quick video on your return on investment and the reason why we don't typically go to uh, single leg positions. We don't typically want to just buy a call or just buy a put, not when we can do something else like put it into a spread. And the reason for it all comes down to our return on investment and our ask out of the market. So let's get into it. So real quick, I wanted to do a little video on this. We've had We've had people coming into the room talking about wanting to trade uh, naked calls or naked puts from an understanding that it's very simple. You know, they're new to options and they think, well, this is the way that I can participate in the options trading while I'm still getting familiar with trading spreads and all of that. But this trading naked positions should not be your go-to. It should be a strategic decision to help hedge your existing trades or as an intraday trade, not as a swing trade strategy. And if you're unfamiliar with the reasons why, it's because of the return on investment. So in this spreadsheet picture here, this is an example of a market, call it, XYZ market. It's a $30 ticker, and we bought a call, for an example, on the left side for $2.50, and it's expiring today. What would happen to the trade? So if I had bought a single call because I was bullish on the XYZ stock, and the stock had not moved, if it was still at $30 and it's the day of expiration, I'm going to lose the entire uh, debit that I paid for that call. All right, so this was a $2.50 call. I would lose all of it. If the stock had moved $1, so if it was $31 now at expiration, and I needed to exit this trade, I would lose at 60%. So I would be in the hole 60%, and that would cost me $150. If the stock had moved $2, so if XYZ was trading for $32 right now and it was time for me to close my trade, I would still be in the hole 20%. I would still lose $50 in that trade. Now for me to break even, if I had only bought a naked call position, for me to break even, I would need that XYZ stock to have moved $2.50. So at $32.50, I could have broke even. And if it had moved a full $3, I would have made 20% in my trade. But I would have needed a $30 stock to move $3 just to see 20% return on my trade. Now, we teach here often that we need to know where we're going to get out if the trade turns against us, or where we're going to get out if the trade actually does what we wanted to do. Right? And so what we do is we use target profit goals. The first target profit goal that I normally aim at is a 55 to 60% profit. If I wanted to do that with this call trade here, I would need that stock to have moved $4. A $30 stock moving $4 is a big move, and I would need it to move that far just to hit 60% profit in this trade. I would see 100% only after the stock had moved $5. That's that's a very big move in a $30 stock. Now, on the other hand, if I was trading the same XYZ stock and I had gotten in with a 30-35 call spread for $1, if the stock had not moved and it was still at $30 at the time that I needed to close the trade, I would lose 100%, just like I would over here. But my 100% loss would only be $100. For me to break even in this trade and not lose but not win, I would only need to see a $1 move in that stock. To hit 100% profit, all I would need is a $2 move. Now, typically, I aim for a target profit of 55 to 65% for my first target. So in this trade, I would really only need the stock to move about $1.50, and then I would hit my target goal just that quick. The return on investment when it comes to trading spreads versus trading naked positions, hands down cannot be beat. Now, once you start factoring in the time decay, if you just grab a naked call or a naked put and you just buy a call or buy a put and you hang on to that for a month, every day you're losing money in the trade. You're paying for the privilege of being in the trade. And you're going to need a bigger move as time goes by just to see that profit. Everything that you do in your trading environment needs to be focused on the return. If the biggest names in Wall Street brag about having uh, a year where they can return your money with a 20% profit at the end of the year, a 20% profit, and we're consistently aiming for 55 to 65% profit in our trades, we need to make sure that we have a high enough win rate and that we can consistently make the same trades. So in this naked call position, we would always need this big move just to see our goals, as opposed to trading with strategy and hitting a high win rate. The return on investment here, coupled with the idea that you have protection if the trade goes against you, you're not risking as much. You can build the spread to stop time decay. All of those things combined, hands down, they beat the call spread. Now there's absolutely a time and a place to trade the call spread or the put. If you want to just, buy a call or buy a put, there's times to do that. Trading a spread does not have to be complicated. It does not have to be difficult. And we've got plenty of videos that teach how to develop the trade with a debit spread. All right, so don't let the spread be the reason. Don't let your fear of not understanding how to build the spread be the reason that you don't trade the spread, because we've got all the material to help you learn that. So I want to thank you for watching the video. I appreciate it, and I look forward to seeing you at the next video.